Hey, listen up, mate. Tonight, while you're sitting on your couch, maybe having a cuppa, feeling pretty relaxed because you own your home, something is quietly going on that could cost you thousands of dollars in pension payments. And the scary part is, you won't even see it coming, because the trap I'm about to show you today doesn't look like a trap at all. It looks like a totally normal life decision. Selling your home, helping your kids out, moving into care, stuff that good, hardworking Aussies do every single day. But inside the Centrelink system, these everyday decisions are quietly triggering pension cuts that are wiping out entire fortnightly payments for retirees all across Australia. Stay with me right to the end, because what I'm about to share with you could seriously save your retirement. G'day Australia, welcome back to Centrelink Info AUS. I'm Daniel Brooks, and this channel is built for one reason only: to give everyday Aussies the real, straight-up, honest information they need to protect their pension and get through the Centrelink system without getting burned. No scary headlines here, no confusing government jargon, just plain, simple facts so you can make smart decisions that actually protect you and your family. If you're new here, hit that subscribe button right now and turn on the bell, because next week I'm covering a massive superannuation update that affects part pensioners directly, and most channels out there aren't even talking about it yet. Alright, let's get straight into it. Now I want to kick things off by busting the most dangerous myth in the whole Australian pension system, and it goes something like this. My home is exempt from the assets test, so my pension is safe. Sounds reasonable, right? But mate, that's only half the story, and that half-truth has already cost thousands of Aussie retirees a stack of money. Yes, your principal place of residence is excluded from the assets test. Centrelink doesn't count your home's value when working out your eligibility. That bit is true, but here's the thing: nobody tells you when you first sign up for the pension. Because you own your home, the limit on everything else you own is a lot tighter than it is for someone who rents. The system basically says, you've already got a roof over your head, mate, so everything else you own needs to sit under a lower limit than your neighbor who's renting down the street. Here are the real numbers straight from Services Australia as of the 20th of March 2026. If you're a single homeowner, everything you own outside your home needs to sit below $321,500 to get the full pension. For a homeowner couple, that limit is $481,500. Every extra $1,000 above those limits cuts your fortnightly pension by $3. And once your assets hit around $722,000 as a single homeowner, your pension stops completely. Your house is still there, but everything around it just became a minefield. And there are 4 danger zones where good Aussies are getting caught out every single week. The first danger zone is downsizing. The kids have all moved out, the big family home feels way too large, the garden's doing your head in, and the energy bills keep going up. So you sell the family home for $1 million, buy a nice smaller place for $700,000, and you bank the leftover $300,000 for a comfortable retirement. Sounds like a smart move, right? But here's what nobody at the real estate office tells you. That $300,000 you kept after buying the new place, that is now a fully assessable asset. It doesn't get any special treatment from Centrelink. It gets added to your super, your savings, and everything else under the assets test. And if that combined total pushes you past the cutoff, your pension can stop just like that. Your house didn't cost you your pension, mate. Selling your house did. Now there is one thing that can help. If you're aged 55 or over and you've owned your home for at least 10 years, you might be able to put up to $300,000 per person from the sale into your super through the downsizer contribution scheme. But please talk to a licensed financial advisor before you do anything, because the timing of this stuff really matters. The second danger zone is gifting. You want to help your kids out. Maybe help the grandkids with uni fees, or give a bit of the home to a child who's been looking after you for years. That's love. That's what Aussie families do. But Centrelink doesn't see it that way. You're allowed to gift up to $10,000 in any one financial year and no more than $30,000 over any rolling 5-year period. Go even $1 over that, and Centrelink hits you with something called the deprivation rule. Here's what that actually means in real life. Any amount you gift above the allowed limit keeps getting counted in your assets test for 5 full years, as if you still have it sitting in your bank account. And on top of that, it's also treated as if it's earning income even though the money is completely gone. You gave it away. You can't touch it. You can't get it back. But Centrelink keeps counting it against you for 5 whole years. Trying to be generous without knowing the rules can seriously backfire and leave you worse off than when you started. The third danger zone is moving into aged care. When a loved one needs to go into residential care, the whole family is already flat out. There's medical appointments, waiting lists, paperwork, accommodation costs. It's a really tough time. The last thing anyone's thinking about is Centrelink rules. But this is exactly when the biggest and most expensive mistakes happen. Here's how it works. When a senior moves into aged care permanently, the family home stays protected under the assets test for up to 2 years. That gives the family a bit of breathing room to sort things out without the pension being cut straight away. But when that 2-year window is up, or when the home gets sold to cover care costs, whichever happens first, that protection disappears overnight. Whatever money comes from the sale becomes a fully assessable asset straight away. And for a lot of families, that one transaction is enough to push everything over the limit and stop the pension entirely. On top of that, the new Aged Care Act that kicked in on the 1st of November 2025 brought in updated fees and new accommodation payment rules that have left many families paying way more than they budgeted for. There's no one-size-fits-all answer here, but one thing is absolutely certain. You cannot make these decisions without proper specialist advice from someone who really knows this system inside out. The fourth danger zone is the sneakiest one of all because you don't have to do a single thing to fall into it. This is the deeming trap. Deeming is basically Centrelink's way of estimating how much money your financial assets are earning, regardless of what they're actually earning in real life. Your savings, your term deposits, your shares, your super and pension phase, all of it gets a deemed income figure slapped on it. And on the 20th of March 2026, the government bumped up the deeming rates by 0.5% across the board. The lower rate went from 0.25% up to 1.25%, and the upper rate went from 2.25% up to 3.25%. For a lot of homeowners with decent savings, this is quietly cutting into their pension even though their actual returns might be way below what the deeming rates assume. And the really rough part is, most people don't realize it's happened until Centrelink sends them a letter saying they've been overpaid and they owe money back. Money that's already been spent on groceries, medications, and power bills. They did absolutely nothing wrong. The system just caught up with them and hit them with a debt out of nowhere. So what do you actually do about all this? Here's your simple action plan. First, sit down this weekend and write out every single asset you own outside your home. Your super, savings, shares, cars, managed funds, everything. Add it all up and compare it to the 2026 limits. If you're anywhere near those numbers, you need to act now. Second, before you sell, downsize, gift anything, or move into care, talk to a licensed financial advisor who specializes in Centrelink and retirement income. Not your bank, not your regular accountant. Someone who knows this system every single day. Services Australia also has a free financial information service that can walk you through your specific situation at no cost at all. Third, know your legal obligations. You must tell Services Australia within 14 days of any change in your situation that could affect your pension. Not reporting on time can lead to serious consequences, so please don't leave it. And fourth, if your assets are technically over the limit but you genuinely can't get to them easily, look into the asset hardship provisions and the Home Equity Access Scheme, which lets older Aussies borrow against their home equity through a government-backed loan. Look, mate, I just want to say something straight from the heart before I wrap up. You worked your whole life for this retirement. You raised your family, paid off your mortgage, paid your taxes every single fortnight, and gave everything to this country. The age pension is not some gift the government is doing you a favor with. It is what Australia owes you. Protecting every dollar of it is not greedy. It is smart, it is fair, and it is absolutely the right thing to do. If this video helped you out today, please smash that like button right now and share it with someone you care about, a parent, a mate, a neighbor getting close to retirement age, because one share could honestly save them tens of thousands of dollars. Chuck your questions in the comments below because I read every single one, and your questions are what drive the videos I make each week. And if you haven't subscribed yet, do it now and hit the bell so you don't miss next week's superannuation update for part pensioners. This is Daniel Brooks from Centrelink Info AUS. Stay smart, stay protected, and always remember this. You earned it, mate. Take care of yourselves, Australia.